Hi, everyone. We're excited to have Shady Josh. Josh here. You can find him on YouTube as Shady Josh, and he's an actuary at an insurance company, but also a lemonade bull. He's objective on the company, but he's excited about the company. He's going to give us his insights on lemonade. So welcome here, Josh.
Thank you so much, and it's great to be with you. And I've been watching your channel probably for a year or so.
Yeah.
So, and then you connected through the comments and so on. But yeah, great to be with you.
Awesome. Yeah. Thanks for being here. First off, could you tell us just tell us a little bit of your background in investing and also as an actuary?
Yeah, and just before that, I think I have to make it very clear that although I'm an actuary, I have zero extra credibility, right? So I'm not a professional advisor or anything like that. So I just have to make that clear that I'm not qualified to give financial advice. But yeah, my background, I'm from London, England, and I grew up east of the city, about a couple of miles east of the city of London. Yeah. And I guess my investing background is that I've always been interested in making some extra cash because I grew up in a low-income family. And so I had to I didn't get pocket money and that sort of thing. So I really had to make my own way. And so from quite an early age, I started side businesses, or I guess they were main businesses at that time. So from when I was 10, I started to collect scrap metal and sell that for cash. And then I got into buying and selling bicycles and then motorcycles.
Oh, wow.
And that turned into actually a really profitable trading business from when I was like a young teenager. I used to go around in London and buy motorcycles, repair them, sell them. And that was really good. And I had other things, like I used to collect fridges, which were like a waste product, and then sell those to a chap who exported those to Africa. So that was like a really, really strong cash flow business because it was a free product. And then I sold it for money. And then I took all of the kind of accumulated and compounded savings from trading. And as soon as I left university, I could qualify for a mortgage, and I bought my first house like 3 months into leaving university. And then I renovated it, and there was an upswing in the market as well. And so I sold it after 2 years, and I made like 300% in 2 years. And then took the equity from that and bought 2 rentals in a region of the UK in North Wales. And mostly for cash, and then those gave me like strong cash flow rental income, and then from there I just accumulated, and I've always been investing in like what I see as low risk, like high reward. So I think, for example, the best investment I ever made was, we have postage stamps here in the UK, and the UK government sets the price. And so they announced one day that on a certain date in 3 months' time, the prices would all go up 40%. So I took a lot of cash and I went and bought a load of these postage stamps. And it was like buying a currency where the market told you in advance that the price would increase 40%. So it was like a zero risk investment because they're essentially a government currency. So I bought loads of those and still have them now, and I use them for my business to send out parcels.
Oh, yeah.
To have a side business selling motorcycle parts and stuff. And then I guess for the stock side, I've been investing probably for like 15 years, and I've been really influenced by Warren Buffett. So I've read almost everything written about him, and his history and the way he did investing, and Peter Lynch as well. So yeah, I've been investing quite a long time. So yeah, there's a bit of background.
Have there been any stocks or companies you've invested, like public markets, that you've been as excited about as you are about Lemonade now? Kind of ones you feel?
I don't think they have. Like, I think there are some investments that I should have made, and I guess that that actually influences my decision because, like, I remember looking very hard at Amazon in like 2010, 2011. And, when you looked at a PE ratio or any objective measure of, why it should be worth what it was, you couldn't do it. And I remember thinking, why are these investors buying this stock? It's just crazy. Like the PE, there was no PE, right? And even in 2016, I remember the PE being 1,000. And so I've learned from pain, I think. And even the same with Google, same with all the big tech stocks. I looked at them at the time, and the numbers didn't make sense at all to justify an investment. And then like I had to go back and redigest all of the history of looking at those big tech companies, why I didn't invest, and what I missed, right? And then I think I see the same with I saw the same with Tesla, and then also with Lemonade, in that like it has all the qualities that those big companies had. It has the same dynamic of like crazy growth, but the financials are terrible because they're reinvesting all of the premium and the revenue into developing the tech and setting up the initial what is going to make it into a huge company down the road, hopefully. So I think your question just now was there any investments I was so excited about? And I'll say no. And the reason is also because mostly I haven't invested heavily in the stock market. I've always invested in things that I have control over, right? So the rental properties, and even today I have a motorcycle trading business that I do on the side of my day job. Right. I've always been primarily focused on those areas. And I think, Lemonade for me is a once in a lifetime stock for me personally. It's like something I've been looking for a long time, and it has now kind of moved into the sweet spot of go and get it. Does that answer?
Yeah, absolutely. That's great. Really quick, as an actuary, what's kind of your background there, or how did you get into that? How long have you been an actuary?
I guess 10 years I've been investing. 10 years I've been an actuary. So I worked for a really big insurance broker based out of the US for 5 years, and then 5 years in a really big insurance company.
Yeah. Could you walk us through like a current sort of legacy insurer? How do they price risk right now? What does their data kind of look like that they collect that they base their risk analysis on?
Okay, so at a very basic level, insurance companies have some data, right? So step one would be getting that data into a format where you can use it for pricing. So they would have like a big block of, let's make a scenario, right? Let's say I'm a home insurer and I have a lot of history. So the insurance company would take the history and they would essentially try and match up risk information, which is like, who you are, your age, your date of birth, where you live, your claims history, that sort of thing. So that is your risk data. And then you have claims data, which is like claims actually come in and are paid. And you match up those two. And then you would basically run what's called a generalized linear model, which is where you use computing power, and you can also do it by hand, which people used to do. And you basically run what's called matrix algebra, and let's say you have 100, or let's say you have 50 risk factors, and you use that in your quotation process to charge people premium or to work out what the premium should be. You use the historic claims data and you use the generalized linear model to solve for these parameters called best estimators of risk, or just parameters, i.e. what factor should age have, or like how should age contribute to the risk premium. And then you have so you're solving for 50 parameters, and then you use those parameters to price the risk. I think I could probably say that a bit more clearly, but does that make sense as a concept?
Yeah, that makes sense. How does that data of a legacy insurer compared with like what Lemonade might have I could only assume like there's going to be much more kind of fragmented on the legacy side, but I don't know, it'd be good to hear more detail on
So,
that.
so the reality is that for many legacy companies, the quality of data is just poor. So I used to work, as I said, as a big insurance broker. So we would have in personal lines books where the broker is trying to place the book of business with an insurance company, and essentially the data would be in Excel format. So if you could have like because Lemonade is a focused insurer, right? So they have one provider, but if you're a legacy company, you may have bought like 10 companies in your past, right? So let's say
Right.
the company was founded in the year 1900, and then in 1930 you bought a company, in 1950 you bought a company, and there's been a lot of integration of acquisitions.
Yeah.
So legacy, there used to be many more legacy insurance companies, right? And the less, the smaller ones and the ones that didn't work out so well have all been bought by the big ones. So if a legacy insurance company has bought a company every year for 20 years, and bear in mind also that computers were only invented like 30 years ago, and so maybe they started out with one data system, then they moved to another data system. They bought a company where that company had a better data system. You can see that an insurance company could have like 20 or 30 different data systems which they've been integrating can like forever. Like, does that make sense, right?
Yeah, absolutely. Yeah.
So it's like if you were an engineer, you're an engineer by trade, right?
Yeah.
If your company kept buying other companies and they all had processes that you had to like squeeze into your process somehow, so you're spending all of your energy just trying to fix everything and make it work together and not building a best-in-class system, right? Whereas Lemonade has just built a ground up, like well-designed system from day one, and they've just iterated and improved. Does that make sense? So the actual architecture is completely different.
Yeah, no, that makes perfect sense. Yeah. Yeah, so how do the costs break down for a typical insurance company? Especially how significant are broker and distribution costs in that?
Yeah. Yeah. Okay. So talking about distribution costs first of all. Well, actually, let's step back. So,
Yeah.
insurance companies typically report a metric known as a combined ratio to the market, and that is the number one metric that the market and investors would be interested in. So, what a combined ratio represents is essentially for every $1 of premium that comes in, how much is retained to the bottom line. And so a combined ratio is made up of a loss ratio, which is an ultimate loss ratio is the ultimate claims, which is the claims that are known today, which is called incurred claims, plus provisions for future and as yet unreported or unreported claims, and also claims that will go up. So that's a term called IBNR, which doesn't need to be covered. So ultimate claims divided by premium would be the loss ratio. And then we have what's known as an expense ratio, which is things like distribution costs, internal expenses, just the cost of doing business for an insurer. And so typically, I was reading that the expense ratio for, in the US for insurance companies is like 30%. And then distribution costs can be very significant, especially so when you look at industry statistics, they will cover like all sizes of company and all sizes of policy, right? So for very big policies, like, the company I work for may sell multi-million-dollar policies to corporations. So that would have a very different distribution cost profile than a small company. So let's talk about a personal lines insurer like Lemonade, where we're selling home and car and so on. So the I don't know how it works in the US, but in the UK, typically nobody would buy from an insurance company or a broker. They would all go onto these websites called aggregators. So in the UK, it's one called like Go Compare or comparethemarket.com. And so a consumer would go onto that website, search for a policy, and find one. Okay, so a lot of different quotations come up. Then maybe they'd buy a policy, but it would be through a broker. And then sometimes that broker would feed the premium in through another broker. And then that big broker would then feed, like, so that would be like a Willis, Marsh, Aon, those big brokers. Then they would feed that as a big portfolio of policies through to the underlying insurance carrier. So you could have almost like 3 insurance brokers, and maybe the first would take 10%, the second would take 25, the third one 15, and then that leaves like, I don't know, 40-50% available to be paid to the insurance company, and then that company has its own internal expenses of 30%. So the figures are just amazing to me for personal lines, where you could have a consumer. And also, don't forget the government takes their insurance premium tax, which is like 10% in the UK. So what a consumer pays, maybe 30% for a small personal lines policy goes to the insurer. So yeah, as you know, really high commissions and costs.
Wow, that's amazing. Yeah, that's great. I mean, contrast that with Lemonade. We'll dive into Lemonade in more detail here shortly, but who just so direct from Lemonade to you, the consumer. Just such a stark difference. Still thinking about legacy companies though. Why do you think it is most legacy insurance companies seem to, as Daniel says, stop at the water's edge? Don't really have, or more, constrained by the country by country, it seems, or maybe continent by continent, possibly. But what are some of the biggest factors there you see holding that back?
So a couple of things. I mean, I think probably the first one would just be regulation. So every insurance company, so regulators have a prudential, they have a responsibility to protect consumers. So like when you look at the global financial crisis, the crisis essentially happened because at that time there was this from the 80s and 90s, there was this thought in the markets and in government that the markets will take care of themselves, right? The free market, you just let the free market does what it does, and the market is smart enough to spot risky behavior and to stop things happening because investors are smart enough to see what's going on, and we know that's just not true. And so regulation has come about in probably the last 15 years as a response to 2008. And so regulators are in local countries, right? Because each jurisdiction has a responsibility to their citizens to protect them. So, and regulation is a huge cost for insurance companies. So if you invest, let's say it costs you're a small insurance company and it costs you 10 million a year in regulation costs to satisfy your own regulator. Well, if I'm in the UK and I have a UK license to sell insurance, if I want to go to France, the French are not going to say, hey, he has a UK license, so I'm sure he's fine. No, they want to see everything all over again. So your 10 million a year cost, if you sell one policy in France, it would double to 20 million, right? And so it's just a cost thing of there are no economies of scale of ramping out to more countries. So that's the first thing, is regulation costs. And then it's also just about underwriting expertise. Is if I'm in the UK, I know the UK market. Why should I have a better insight into a risk in Paris than a French company? Like, it just doesn't make much sense. I'm not there on the ground. I'm not talking to local people. So it's like an underwriting expertise thing. And then I think thirdly, it's just a logistics thing. So if I sell policies, if I sell you a home policy and your house burns down, I have responsibility for making sure your house is rebuilt. In insurance terms, we call that indemnification, where the insured person is reinstated to the position they were in before the risk event took place.
Mm-hmm.
But it's going to cost me a lot more money if I have to talk to somebody in a different time zone, a different language, a different everything. It's just going to be hard work. And so I think that's why as well people stop at the water's edge, is because it's just hard to do business across countries, and really you're at a disadvantage to the home insurers.
Yeah, that makes perfect sense. Is that a risk or issue for Lemonade then? I mean, expanding globally and their ambitions to do so seem like the regulations for sure would have the same risk or challenge there. But even
Yeah.
some of the logistics challenge, it always seems like to me that the advantage they have is okay, they just have an app. So boom, they don't have that broker logistic at least. That's just that whole aspect is much simpler. But is that like what's your view, I guess, if Lemonade's successful, do you see them really going globally?
Yeah, I think they will, but I think it might be slower than we would hope. And
Mm-hmm.
as boards, we would think, oh yeah, they'll just ramp out to every country on planet Earth within. I don't think that's realistic, because we know that well, it depends which policies we're talking about, right? So if you
Yeah.
talk about a pet cover, for example,
Uh-huh.
you could probably sell pet insurance to a completely different country, because a lot of the claims are just, here's an invoice from my vet. It cost me $2,000 to have my dog's leg cut off or whatever, but my dog
Mm-hmm.
fixed essentially.
Yeah.
Here's an invoice, send that through, and the claim is automated. But for something like a home policy, like
Mm-hmm.
we're talking about real loss events. So, we're talking about fires and floods and subsidence, and you need somebody to actually go and have a look at the house,
Mm-hmm.
figure out how to fix it, engage with local contractors. So there's a lot of on the ground legwork to be done. So I think that would be a challenge. And for that, I think you really would need either a local presence, or more realistically, you would need to engage with like a subcontractor. So most insurance companies don't do their own claims handling. There are
Mm-hmm.
specialist companies called claims handling companies where
Mm-hmm.
all of the claim would be outsourced. So you could ramp out, Lemonade could expand, but they would need to have really good partnerships with claims handling companies. And
Right.
that would come with its own risk of brand dilution and,
Mm-hmm.
not treating customers in the way that Lemonade would want to happen, because,
Mm-hmm.
you just got a different company involved, and now you're
Mm-hmm.
you're losing control of the customer feel, which is the whole
Mm-hmm.
USP of Lemonade, right?
Yeah.
Is how it feels to customers. So hard to say. I think it will come, but in time. I think Lemonade first would really build a big presence in the US, and then they'll
Uh-huh.
have some key infiltrations into new markets. So like Germany and France, we have at the moment. I think reading between the lines, the UK will probably come quite soon.
Yeah.
So yeah, they'll be in those big markets, but they won't be in every country.
You said on one of the comments, and this sort of sparked this discussion, you said that Lemonade is literally a textbook example of a perfect insurer in my view. So what did you mean by that? What excites you the most about
Yeah.
Lemonade? Yeah.
Yeah. So Lemonade being a perfect insurer, what I mean is, if insurance at its core came about to share risk between people, right?
Mm-hmm.
So let's say there's a group of 1,000 very similar people with very similar circumstances and similar assets.
Yeah.
So let's say, you and I, let's just make up that we're both 30 years old. We both live in the same city. We have the same jobs. We have the same everything, and we have the same house.
Mm-hmm.
Now, if let's say there were 10,000 of us in that scenario, and we're all paying premiums to a legacy insurance company that are just random, okay, and they're all
Mm-hmm.
different. It's not fair because we all have the same risk. But imagine if we could, instead of buying an insurance policy, if the universe just said, hey, you will implicitly pay some, some tax or whatever, and some money goes into a pool which is proportionate to your risk, and then when you have a loss, you get the money back, and so you're protected. And I guess that's the way that governments work, is they tax citizens to pool citizen funds together so that when big events happen, there's some money available to do stuff. So Lemonade at its core, I think, could be the perfect insurance company if they are able to bring equitable premiums to the market. So if my premium that I'm charged really is reflected, it really reflects my risk very accurately, then that
Mm-hmm.
is fair to me and to the insurer, and it's fair to the other people in the pool. And I think Lemonade has a much better chance of really accurate pricing. And when I mean accurate, I mean that the dollar amount, so $250 or $300, it doesn't sound like a lot, but it's a huge difference when you run an insurance company, right? Because most combined ratios are 95% or worse, maybe
Right.
98%. So
Right.
a 20% difference in premium for 20 million customers is a huge difference. And that is the difference between a company making billions of dollars and not. Just that $50 differential. And
Right.
so to have that accurate pricing, you need to literally basically be God. You have to know that customer's risk. And the only way I think to do that is to really use very, very differentiated and rich and expansive data. And you can't ask a customer loads and loads of questions, because we talk about how to price a policy. There's risk factors, which is essentially how risky am I, how likely am I to make a claim, but I don't know that, and you don't know that. So what we have to do as an insurance company is use rating factors, and they're called proxies for risk.
Mm-hmm.
So, for example, age might be one for a life insurance policy, or age of house built might be one for a home insurance policy. We're saying those factors give an indication as to risk, but we don't know what the risk is. So
Mm-hmm.
Lemonade, I think, if what they say is accurate, that they're able to capture 2,000 data points,
Right.
if those give a good indication as to true underlying risk, then their pricing will be much more accurate. And
Mm-hmm.
then that allows you to grow, because you're charging the right customers the right premium. So
Yeah.
there's good growth and bad growth. So bad growth for an insurance company is where you just undercut everybody, you attract loads of new customers, you grow your book at 100% per year, and then actually they all have a claim and you lose your shirt,
Yeah.
and that's what we
Absolutely.
don't want. So
Yeah.
it's you need growth with accurate pricing.
Yeah. Absolutely.
Does it help?
No, that's perfect. Yeah. And that my question always with Lemonade is okay, they have 2,000 data points. We know they have tons of data, but then I always wonder, okay, how many of those data points are meaningful signals or not, And we were just, when we were prepping for this, talking a little bit about this interview. One example you gave that really struck me was that typical insurers talk about, or if somebody pays for a full year, or if somebody chooses to pay monthly.
Yeah,
In my head, I just think, oh, there's probably some discount because you're getting more money up front now for the full year versus month to month. But actually, that you said the reason that for that difference is because that person who's only choosing to pay monthly, and maybe their funds are tighter and life circumstances, whatever, I'm just sort of assuming, they would tend to have a higher risk profile. So that is a signal, that is a really simple signal that a legacy insurer, just through that process of choosing
yeah,
insurance, that you guys kind of would capture and be able to and profile on and risk adjust appropriately for.
Exactly.
So that example gave me more confidence. Like, well, I guess like that those 2,000 things, like maybe if it's maybe just together, the sort of concert, you have enough of them together, you say, oh, this person's really risky and we really don't want them as a customer. It gave me more confidence there. I guess that would obviously that must be your sense too. That
well, I mean, but it
could
makes
be
sense.
meaningful signals there, right?
But just from an academic or a technical perspective, that is how you price risk. So what we're talking about there is, as you say, somebody who can't afford to pay a year's insurance premium probably doesn't have much money. I mean, no disrespect to anyone who's in that situation, but you probably have less money to someone who says, "Oh, just get it out of my way. I'll just pay and then it's done." And so that is a strong indication, because we go back to the generalized linear models, which legacy companies use. That will be one of your one of the things in the matrix of data that you're going to fit parameters to, right? So you have parameters, maybe we'll call them alpha 1, beta 2, Charlie 3. So we can go back to that example. So that how we price data, how we price the risk is, we have, let's say we got 10 million customers,
right,
and 1 million of them paid on a monthly basis and 9 million paid on an annual basis. Then we would be able to use our GLM to compare the claims history and the frequency of claim and the severity of claim,
right,
we would basically map back to what payment method, and then you solve for that parameter. So what GLM does is, for every parameter you're trying to fix, you freeze the variance. So you iterate. It's like a stochastic process where you would freeze all of the other parameters, and you say, just by varying the pay monthly or pay annually, what does that do to my expected loss cost, right? And your computer does that for you. And it turns out there's a very high indicator here. So the expected loss cost increases, and my confidence interval around that is quite high. So let's say 99%. And you say, well, clearly then I should adjust my pricing, because my best estimator is saying that the riskiness of these customers that pay like annually is lower. And so if Lemonade can capture like 100 data points, like for you and me, because of the time difference between us, I'm awake here at 4 a.m. in the UK, right? Now, let's say I log on to lemonade.com right now and buy a policy. They will capture that I'm on my PC at 4 a.m. And that may be a really strong indicator that the guy who's on the internet at 4 a.m. may be drinking. Maybe I'm having a beer right now, and I'm gonna get up in 4 hours and drive to work, right? I still have alcohol in my system. That'd be a great indicator for the risk of driving your car, right? You haven't slept, so you're probably not gonna do a great job of as good a job of driving to work safely as somebody who went to bed at 9 a.m. with a hot chocolate, 9 p.m. sorry, and they slept through till 8 a.m. and they're just so you see that that's a risk indicator. If you can really get into the data and really use the machine learning, but also just common sense, you think, well, just thinking about things like, what would that risk factor do to risk? Like, you can almost just do it by just thinking, right? But if you don't have the data, then you can't bring that into your pricing.
Right. What would you say? And I could probably guess the answer. But if Lemonade has 2,000 data points and they say, well, then why are their loss ratio? Why is it as high as it is? Why aren't they crushing the loss? Why don't they have the best loss ratio in the world already? I would assume it's sort of you need some history there to train and say, just like you're describing, you need to know the monthly payment users and the annual payment users. You need some history to say how big of a signal is this, right? Would that be kind of the biggest?
Obviously. Yeah, I mean, let's just make up an example, right? Let's say we sell home policies,
Uh-huh.
and if I start an insurance company on day one,
Yeah.
I don't know what my pricing should be at all.
Mhm.
I'm just going to have to guess, right? So I'm going to say, well, I need to get trading, I need to get some premium coming in, and just need to get off the ground, right? So I'm just going to basically guess that that guy should be charged 200 and that guy should be charged 300, but I don't know.
Right.
And
Yeah.
then as time goes on, a year later, the guy, one guy had a claim and one guy didn't have a claim, and now you've got some data and you say, well, and now you have 5 million customers, for example. You say,
Hmm.
okay, so all these guys had claims, what have they got in common?
Hmm.
And you just grow your knowledge, right, of how do how do the attributes of each consumer reflect the underlying risk? And obviously the risk, you find out what the risk is when you have a claim, right? You don't know the risk
Hmm.
until that claim comes in. And
Hmm.
so it does take time to work through the just the experience of how to
Hmm.
price policies accurately. So I think it's just a time thing. And
Hmm.
that's why I'm really not that concerned. I'm an investor in Lemonade, and most people say, oh well, the loss ratio is high, and yeah, sure. So what? It should be high. If it
Hmm.
wasn't high, you'd think they've got dodgy accounting, because the concept, by definition, their loss ratio should be high because at the start they don't know how to price policies.
Hmm.
But over time, the experience comes through and they refine and iterate and refine prices, and then actually they figure out that a subsection of the book is more risky than the other subsection even before they have a claim. And so when their policies come up for renewal,
Hmm.
all of the risky policies get increased, rates, maybe a rate increase of 20%. So we do that in the industry all the time. As a pricing actuary, you would look across the portfolio and say, yeah, based on like the experience over the last few years that I'm seeing come through, I
Hmm.
think that this subsection of my insured book is risky, and I'm going to increase rates for those. And
Hmm.
then that's called remedial action, where you are addressing the problems in your portfolio
Hmm.
by pushing through rate increases and underwriting actions for those groups of people that are more risky. So Lemonade will be doing that, but it takes time. And so I'm not that concerned about the loss ratio,
Hmm.
from a
Hmm.
technical perspective, at least.
Yeah. Do you think, like, how is it significant, or could it be significant, somebody's risk profile, say, that they start to develop, but between products, if somebody
Yeah,
starts to sign, if somebody's, in my, like you're saying, is like intellectually or just thinking about it, I don't have, it makes sense to me. I don't have the data to back it up, but it makes sense. Like, if somebody's driving their car safely and always at the speed limit, and is signs up at a normal time of day, and like have all these signal to say they're really conservative, low risk person, it's like they're probably also going to be low risk, maybe homeowner, and more conscientious that they don't leave a candle lit in the one room and forget about it, or something, or
yeah,
except,
yeah, yeah.
does that make sense to you, or does there even data, or is that something you're expecting Lemonade
No,
as part of the thesis?
yeah, absolutely. And I think that will be a really, really key differentiator.
Mhm.
To my knowledge, and I've worked in the business for a fair amount of time. I don't think many people use cross policy pricing. I just don't think the data is there. I've never come across people doing that. They should, because as
Mhm.
you say,
Mhm.
it's about attitude. Really, that attitude, and the way that I want to live my life. It's like let's say there are two people. One person is somebody who, let's say the Simpsons, Ned Flanders, right? I think that's his name.
Yeah.
He just is a pretty solid guy in society. He wants to do his bit. He's going to pay his taxes. Um, like there are definite overlaps between all of the risks for different policies,
Mhm.
just based on my attitude to life. So
Right.
like for example, somebody who is willing to drink and then drive their car is like infinitely more likely to do a fraudulent home claim, because their attitude is, well, screw the man, screw the government. I'm going to do what I want to do because I want to do it, and they're going to be much more willing to take risks that somebody who is like a good, let's call them a good citizen, they wouldn't take those risks, right? Because they just don't want to be a bad person.
Yeah.
So yeah, I think there are
Absolutely.
huge opportunities for
Yeah.
cross policy pricing where you have an indicator from like what somebody did as a renter. Then you've got a really strong indicator of what kind of consumer they are, and then you bring that through to your pricing and underwriting for a home policy, right? And you've got 2 years of history. The person acted in a way that you thought was good, and your model says that it was good. Yeah, you bring that through to the home pricing.
Right. Yeah, absolutely. Interesting to hear you talk about telematics and Lemonade's car policy. Yeah, again, when we were chatting just before in preparation for this one, another thing that really struck me was telematics. Usually we think of, at least I usually think of, is like, okay, what speed are you driving? What kind of accelerations are you feeling in your phone, right, as you're driving or turning or braking, slamming on the brakes. But you made this point about it's also where you're actually going and when. It's kind of like that app sign up. Can you just talk about that a little bit?
Yeah, so traditionally telematics is, as you say, like how fast do you accelerate, what kind of cornering speed do you do, and that sort of thing. But really, that is just one aspect of it, and it's important, but I think more important is, as we say, when I'm an insurance company, I really want to get into like, who is this person? How do they see the world? What do they do? What are their values? What are they all about? What's important to them? And yeah, as you say, if I'm a guy that goes to the bar strip at 3 a.m., let's say the telematics picks up that I've been to the bar strip at 3 a.m. and then I've been sat in my car in a red light district from 3 a.m. to 4 a.m. and telematics records that data, right? Does that give you a signal as to what kind of person I am, as opposed to maybe somebody drives to church, so their car goes from their house every single week at 10:30 on a Sunday morning, and then it stops in the parking lot at their local church for 2 hours, and then it goes back home and sits there while they have Sunday lunch, and then it goes to the golf course. Like, which person is more risky, right? For me, at least, it would be the second. So the first person would be more risky. And so telematics really, I think, is about picking up on behavior, not just how you drive, but like, what kind of person are you? And I think if you have good enough either pricing actuaries or just AI, you can pick up on those nuances. And I think that's such a huge opportunity for Lemonade.
Yeah, no, that's very cool. Anything else you want to talk about with underwriting side of things?
I guess, it's just worth reinforcing the point that underwriting and risk selection is bread and butter for insurance companies. If you can underwrite, because pricing is how much do I charge, but there's also underwriting, which we haven't talked about. So pricing is so far we've somewhat assumed that I'm Lemonade, and no matter who walks in the door, doesn't matter who applies for a policy, I'll sell them a policy, and I'll just vary the price according to risk, and that's pricing. But underwriting is where you say, actually, I've taken your risk into account, and I don't want you as a customer. Sorry, you don't fit my view of risk, right? So maybe that guy who goes to the bar strip at 3 a.m. and the telematics picks up on it. Let's say he's a car customer with Lemonade, and so the AI has picked up on it. He's going to the red light district every week at 3 a.m., sitting there for an hour, and then 6 months later, that guy applies for a home policy. Maybe the underwriting decision is, actually, I don't really like you as a customer. I'm just going to say, sorry, we can't offer you a policy at this time. So that's underwriting. So if you strip out the, the 10% of riskiest customers, you're going to do really, really well, right? Because your losses your significant losses come from probably quite a small group of people. And as an insurance company, if you can just avoid your top 1%, let's talk about like claims frequency and severity. So claims frequency is just, so we have this thing called exposure measure, which typically, let's just say it's like how many policies of us at basic level, how many policies did I sell? And then frequency is per 1,000 policies, how many claims did I have? So let's say I had 5 per 1,000. So my claims frequency is 0.5%. And then claim severity is just essentially average claim. So for a home policy, maybe your average claim amount is $10,000, let's say. But there will be some very, very big claims. So there'll be some, like for example, if Lemonade sells a home policy to someone in Manhattan and some event happens where their penthouse is destroyed, that's $5 million, and that's one big loss, right? So if you could get rid of like the top 50 losses in your book every year, you would make an insane amount of money, because insurance companies make or lose money based on those huge losses. And so underwriting is about trying to spot where those big losses will come from and just saying, I don't want that customer because I think they could cause me that $10 million loss. Does that make sense?
Yeah, that's perfect. Yeah, no.
About risk selection.
Yeah, absolutely. Yeah. Tell us a little bit about reinsurance, especially Lemonade's strategy with that, even for people that aren't familiar understanding reinsurance. Yeah, give us some perspective on that. Is that a good thing for Lemonade, bad thing?
Yeah, so I mean, it's a good thing to cover because there's been a bit of, I would say, confusion about the reinsurance for Lemonade. So, for example, ARK Invest, I guess it was a brief comment, let's say, but they said, well, Lemonade has got reinsurance and we think it's very risky, so we're not investing in the company. And when I heard that, I was really like, wow. Okay, so there is an opportunity here, because if ARK Invest are saying that, then the company's misunderstood. And I think, people outside the insurance industry may not even know reinsurance exists. So reinsurance is just where an insurance company buys insurance. It's as simple as that. So common types of reinsurance, and I think Lemonade buys all of them, is quota share. And for quota share, I think at the moment Lemonade has a 55% retention, and then they what's called seed or give away 45% of premium to a reinsurance company. So for every $100 that they receive in premium income, automatically $45 goes to the reinsurance pool, and I think it's 55% is kept by Lemonade. And then when claims come through, the reinsurers would pay 45% and Lemonade would pay 55%. And so that's just a splitting of premium and claims in those proportions. And what is misunderstood, I think, is people say, oh, well, you're a reinsurer, you use reinsurance, so you're very risky. But that makes zero sense, and I'll tell you why. You think about some of the most profitable companies that work in the insurance space, they're actually not insurance companies, they're insurance brokers. Because you look at Marsh, Willis, AIG, not AIG, sorry, Arthur Gallagher, probably the three biggest brokers in the market. They sell a lot of insurance policies, but they use 100% reinsurance because they don't keep any risk on the balance sheet, right? But somehow they make a lot of money. So how is reinsurance risky then? So you could see it this way, is that Lemonade is partly an insurance company and partly it's just an insurance broker. No one has ever said that, I don't think, on an insurance on an earnings call. but it's like a hybrid model. Is partly you're an insurance company, but partly you're just an insurance broker. And instead of you retaining the risk as an insurance broker, you just give it all away, right? So Lemonade is like a blended average between those two. And the thing about using reinsurance is it's not free for the reinsurer. So Lemonade pay, or an insurer would get a ceding profit commission. So in exchange for, so think about it from the reinsurance point of view, right? You're a big insurance company or reinsurance company, and you've got $100 billion of capital sitting on your balance sheet, and you say, well, I'm not getting any return, like interest rates are 3%. Where can I put this capital? And I want to get it back with, say, 10% return, adjusted for risk. And so you say, oh, there's Lemonade. I'll give them my capital, right? And you're tying up your capital to enable these policies to be sold, and then you would get a return on your capital, right? So it's attractive from a reinsurer's point of view, but in return for, like, it's basically distribution costs. So it's very similar to paying a broker's commission. You basically are paying Lemonade a 25% commission, which is like almost exactly the same as an insurance company paying a broker 25% commission on behalf of selling the policies, but also in this case managing the claims and the relationships and everything else. So Lemonade would get a 25% income, commission income, and so actually using quota share reinsurance reduces risk, because number one, you are offloading some of the risk to a reinsurer, like the claims risk. Number two, you're getting income, which is 25%. But number three, no one really talks about this, is one of the technical reasons for using reinsurance as a new company is that you would benefit from the reinsurer's expertise. So let's say one of the reinsurance partners is a company that has sold home policies for 100 years, right? And say, well, we're going to go into business with you, Lemonade, but you don't know what you're doing. We see your potential, but you don't know what you're doing. So let us send you, a couple of members of staff for a couple of months, and maybe the actuaries or underwriters. Let us have them sit down with your guys and just look through. I don't know if this happens, but it does typically happen. Is that there's knowledge sharing between the reinsurer and the primary insurer, and so that really helps with underwriting, because there's just data that big reinsurer has that Lemonade won't have. And maybe they say, hey, that neighborhood is very risky. You don't know it, but we've had a lot of claims there. Maybe don't sell policies there or increase prices. So that's another reason. So that was quota share. And then there's excess of loss reinsurance, which is just where, let's say we have $1 million cap on losses, right? So if an insurance company buys excess of loss reinsurance, let's say excess $1 million, then if a loss comes in, then they would only get the first $1 million. So very, very common for motor insurers to buy excess of loss reinsurance, because you could have an auto loss where one claim is $50 million, right? And you don't know where in the industry it will hit, but somebody will have a $50 million loss next year. And so as a primary insurer, you buy excess of loss to offload that risk.
Okay.
So the reinsurance really reduces your capital cost, because it's the regulator can really see that you're less likely to go insolvent because of the reinsurance. And so what that means is that reinsurance really reduces the capital needed, and then you can expand faster. So quite a long section there, but
yeah, no,
I
it's
think
good.
it's important.
And that's really important. That the required capital piece important for a company like Lemonade that's trying to grow as quickly as they can and bring in more premium. It's like, well, if they would run into problems quickly if they didn't have that extra insurance in place. And I didn't realize or know that. I never heard somebody say that aspect of where the reinsurer for a new company actually is going to bring in some expertise and knowledge, like a better starting point, some history there than they would have had otherwise. So, which it makes sense. It's in the interest of the reinsurer that they have, the best starting point possible. Now that's really, really good. I think it was it's like the recent Q2 letter. That was was that a sort of a turning point for you, for like even technically, or or like where the stock was at and where?
It wasn't a turning point. So I always thought Lemonade will get there. I don't know when. So yeah, I guess it's a timing thing of like, I see a company like Lemonade as, we talk about conditional probability, right? So just switching to Tesla for an example for a second, I think personally, I can make a case that Tesla now as an investment is less risky, even at 20 times market cap, than it was in 2019. So it's like a conditional thing, right? So given that, because Tesla 20x'd, now I can invest, because now it has capital and the risk is gone, right? So it's like you say, oh, I miss Tesla, but actually the Tesla you invest in today is completely different to the one that was 3 years ago, because the risk is gone. And I think the same for Lemonade, is that when they get to profitability, that conditional element will happen. So I think the year that Lemonade posts a full year of GAAP EPS profits, I think the stock will probably a minimum 10x from where it is today. But then the risk is that you don't know. But I think even if people didn't want to take, like, Lemonade right now is very, very risky. You've got to be objective about that. And I don't want people putting their money in without really appreciating that there's quite a high chance that Lemonade doesn't succeed. But if it does get through to profitability, and that's a 10x, and you say, well, I can't buy now. But I think you could buy it after 10x, and then conditional that it's already 10x, and then probably raise some capital. Then from there, it could 20x, right? So like from this point, I think we could do a 10x and then a 20x, so like 200 times. But it's extremely risky from a probability point of view. So is that the question? Or
yeah, no, that's perfect. Yeah, that really, the massive possible upside is there. What are some of the biggest risks you see?
I think the biggest risk is just solvency. So, Lemonade has $1 billion in cash. And actually, a quick side note on that. I have a guess, and it's, I think, quite a good guess, is that when Lemonade bought Metro Mile, that reduced risk, because the $155 million of cash came onto the balance sheet. So that's a nice cash injection. But also, in the couple of days after the Metro Mile announcement, there was this announcement, which was actually my buy signal. There was an announcement that they had sold, I forget what it was, some software system to another company. And I have a feeling that that's going to be like either a significant cash item or maybe a recurring revenue for a bit of time, because I picked up on a call from Tim Bixby the other day, and he said, "Oh, I can't say too much about it, but this is gonna increase our cash position for some time to come." And I thought, okay, that's interesting. So maybe that could be like, they get paid so much a quarter for 3 years or something. But I think it was the Metro Mile deal closing was like huge for me. I was like, that is, and then from there the stock was ticking up, and I really prefer to buy into good technicals. So the stock coming down from like 100 and whatever it was, 160 down through all the way through, I was watching, and I was like, I'm just not buying this because the technicals aren't there. I'm not averaging down. I'm not touching it. But when it hit, I think it hit like $18 and then bounced off 18 quite a few times. And then 6 months through, and then you've got the whole inflation story of like the whole market is basically betting on inflation going to the moon forever. But then I look at the other thing was like in June, I was looking at leading indicators like copper prices, oil prices and stuff, and the commodity prices have come down like 30-40%, but the market and the Fed and everybody is saying inflation goes to the moon forever. I think, well, hang on a second, we've got 3-month leading indicators. So Lemonade is like a high risk, high beta bet where I'm essentially almost betting on inflation rates as well, and then by definition interest rates, because I think if we had a Fed rate go back from like 4% to like 2%, risk assets like Lemonade would explode. All of them would explode. But coupled with that, you've got the story of like the actual fundamentals rapidly improving, I would say, over the next 4 quarters. I think we could see like Q4 this year, I think we could see a much lower losses as a proportion of revenue than we've seen at Q2. And then if the market has those metrics and it sees like revenue as a percentage of loss as a percentage of revenue, like kind of peaking and then sort of slowly coming down, then that would be like a really strong thing for the market. So like just it's hard to explain in a few words, but overall I just feel like now is like a green light for me personally, that the risk reward right now is like with $1 billion in cash, a burn rate of whatever it is, 240 a year, but that's like a historical thing, and the growth, I think the risk reward is good right now. But again, just my personal opinion.
If you had to put a probability on it, like that they're either successful or they fail, you know, where would you? I mean, obviously it's just it's nobody really knows. And even
nobody knows
one day to the next, you might even feel a little bit different or whatever, you know. But
let's be clear, right? Nobody knows, and I'll explain why I think that. If let's say, for example, you invested in a small cap oil mining option in Eastern Russia or Eastern Ukraine last year, and somebody said to you on YouTube, "Oh, what's your estimation of success or failure?" You wouldn't think of, essentially World War III, right? That's a risk event, and so the way I see things is that like a flow of random probability, a random stochastic variable, and so it becomes like it's like saying, oh, what probability would you say interest rates or inflation rates will be 20% in 2025 or 0? You'd be like, well, I don't know. But what you can say, and I think probably the better way to say it is, what's the weighted average, what's the weighted probability, right? So if you were to say, instead of reframe the question, right, instead of percentage fail or success, what is the expected outcome? Given that we know that losses are, so the minimum stock can be 0, but the maximum is infinity, right? So if I was to come up with a probability distribution and then also assign weights to outcome in that situation, I'd say I think it's like a 5x just on a expected probability basis. And to work that one out, like you're just saying, maybe it's a 1% chance it does 100x, and I don't know, I think it's probably like a 20% chance it does 20x or something, and then work back, and it's probably objectively it's like 30%, I would say, that there's a pretty much a failure in the capital terms, but you just don't know. But also I think because Lemonade has been around for some time, and also there are some quite big institutional investors, I think it's more likely than failure that there would just be more capital raising and dilution. But I really don't mind being diluted in a company that could 100x, right? Because even if, so let's just say today, if Lemonade went to the capital markets and raised like $10 billion, and then that dilution meant that I had 10% of my original investment, I don't think I'd be that unhappy about that, because if it 100x's, I still make 10x, right? So I think much more likely than failure is just dilution, which I don't think is a bad thing. Like Tesla was diluted, I think it was in 2020 or like late 2019, Tesla raised $2 billion by diluting shareholders a bit, but who cares, right? Tesla was still great.
Yeah.
Does that make sense?
Yeah,
I mean,
that's
what are your
perfect.
thoughts on that? Like, how do you think about that whole question?
Yeah, I mean that's a better way to phrase it, that kind of probability distribution of success,
Yeah,
the possible outcomes. So yeah, you're sort of saying like the average, the midpoint, if you kind of balanced it out, would be like maybe a 5x, like somewhere, obviously
yeah.
to
I,
think about it
I would
more, but
say, I'd say that yeah, the weighted average is 5x, but I want to
right.
be like super clear. I have to be super clear that
Yeah.
I'm not saying lemonade will 5x. It could
Yeah.
go to zero.
Yeah.
And I think the ideal scenario
Uh-huh.
would be if you had 100 lemonade investments. Like if you could
Yeah.
replicate lemonade investment 100
Yeah.
times and then have a fund, that would be
Uh-huh.
way better than investing in lemonade, right? Because some of them would fail, but we don't have that situation. It's like someone
Hmm.
said to Warren Buffett, well, why don't you buy loads of different things? And he said, well, you're just not going to find that many great companies. He said, they're not out there. Like
Hmm.
maybe there's five.
Hmm.
And I think he was talking about Coca-Cola. He's like, I'm really heavy into Coca-Cola because
Hmm.
there are no more Coca-Colas. It's like with Tesla or Amazon or Apple, you
Hmm.
can't buy 100 apples. There's one. Um,
Hmm.
so yeah.
Yeah, it's
So I
perfect.
mean,
Yeah.
yeah, that's it.
Yeah. Yeah. Anything else you wanted to we should touch on?
Yeah, I mean, I think for me, I just want to sort of reiterate for your viewers, lemonade could go to zero, like really straight up with that, but it could also do crazy, crazy upside. So for me, I'm like in a philosophical place where, I mean, I hope my family and friends don't watch, but like if I lose the cash I've put into lemonade, I'm good. I think for me, actually, it's like let's say I put in $10,000 into lemonade
Hmm.
and it 100x, so it went to $1 million. Or maybe let's go a bit bigger. Let's say I put in $100,000 and it went to $10 million, and then from there it was still growing, right? And then when it got to 100 times, I'm getting a 1% dividend a year. So imagine if I put in $100,000 today, and then in 20 years' time the stock is 100x and it pays a 1% dividend. Now every year I get back $100,000, and for me, I'm putting it's all in a tax efficient account, so zero tax of any kind.
Hmm.
And so then I could have $100,000 a year tax free to spend, which is like a good situation, right? And that
Hmm.
would allow me to do things that I will not be able to do if I don't
Hmm.
make a similar investment. So for me, that's my angle is I want the tax free dividends in 20 years time so I can do
Hmm.
what I want. Um, but it doesn't make it a good investment for someone else, right? Someone else has different goals.
Hmm.
So I think first of all, like to invest in a company like Lemonade, you have to
Hmm.
really know why you are doing it, and also you
Hmm.
have to be like super honest with yourself about if like recently we saw the stock go up. I was buying in 20, 21, 22, 20, all the way up before earnings, and then we hit 32 or 33 right after earnings. And then I was like, okay, and I was up a lot. Like I was up 50% in like 3 weeks, and I thought I should sell this, but I thought no, I'm gonna hold because I thought it could short squeeze up and get to $100 or whatever, and it could have.
Hmm.
But then the macro came along and just hammered it because and all the stocks sold off. But
Hmm.
then, again, you run a stochastic process where it could have gone to $100 or whatever. But now
Right.
it's like it went from 33 down to 22 again in like a week or 2 weeks. And so
Hmm.
if you want to invest in a company like Lemonade and you can't take that drop in 2 weeks, then you can't invest. You got to like face that question first, right?
Yeah, absolutely. Yeah. Yeah. Yeah, no, there would be people it's not the right stock for, and maybe just
Yeah.
not the right investment goal, or even the percentage of their portfolio is a major question for each person. But
How do you see the risk of like the volatility? How like when the stock drops a lot, what does that do for you emotionally in your frame?
honestly, I mean, I don't, yeah, for especially a company like Lemonade, I don't feel that bad. No, part of me almost
Yeah,
wants the stock to go to $15 a share or $12 a
yeah.
share and just get wiped out in the next like 6 months. It's like
That's what you wish for.
pardon?
Be careful what you wish for.
Yeah,
You might get it.
yeah, yeah, it might come. I mean, that you're
I
kind
don't
of,
want to go
I'm
through that.
like divided in the interest, but also I
Yeah,
know it would be better for them if the stock really took off and there's a short squeeze or something, they could raise money at a more attractive
yeah,
valuation, and that'd be even a great scenario too. So that, I mean, that's kind of your ideal. Um, but
yeah,
I don't know. Like to me, yeah, but it doesn't affect me much if the stock goes down. My mind is like, well, the amount of reward that's there is actually growing. So the stock went
yeah,
down for anything new I'm purchasing. Because if they're successful like by 2030 or 35 or whatever, it's like it's not going to matter what the stock's doing right now.
no,
At that point in time, it's going to be the same sort of ending point no matter what.
yeah,
um so if I can buy it for $16 a share, or I can buy it for 30, if I can buy it for 16 and keep adding to my position, that's,
yeah,
I mean, that's kind of exciting. So, so,
yeah,
so I don't get too concerned about the day to day. I definitely consider
yeah,
myself a long-term investor. I'm not really that worried. I don't even check the stock
yeah,
every day necessarily. Um,
yeah,
it's like,
yeah. Agreed.
so yeah, that's sort of, I
Do
guess,
you
my,
could you see a world where you would ever go like all in? Because I think at the moment you have a lot of Tesla. Could you ever see a world where you say, hey, Tesla was good, but this is better, and just go all in?
it's a good
Or do
question.
you think that's you're not there yet?
I'm not there yet. Yeah, but I agree. Like they're the kind of company that could 5x, 10x, and then could do another 10, 20x after that.
Mm,
Is where the risk actually, like the risk scenario of that sort of probability graph you plotted it out is actually that maybe it's like two humps is more I see is like a risk side, and then there's these outcomes that are huge sort of positive outcomes. And if that risk side like shrunk more, maybe that means this is also like maybe this is shifting over because it's not as much.
yeah,
Maybe they go up 10x, but there's still, maybe
yeah,
I think, hey, they went up 10x, but they're going to 20x or more in the next few
yeah.
decades.
I think you could
Then
make
I could then I would like shift more and more over to, and then that shift is sort of happening. I'm like adding Lemonade slowly, and if they
yeah,
perform like they're saying, even next quarter, next few quarters, and I'll slowly keep adding. I'll be sort of shifting it over. So yeah,
yeah.
what were you gonna say there?
I think you could make a case that the higher the stock price goes, the lower the risk. Just even like we talk
Mm-hmm.
about risk, uh, but even like the dollar you put in,
Mm-hmm.
like it's almost like the reward is higher. I feel that way with Tesla. It's like I was much more comfortable investing after it had gone from like pre-split, like from whatever it was 60 to 900, that back down to 600, which is when I
Mm-hmm.
invested in like March 2021. I
Mm-hmm.
missed all the upside, but I
Mm-hmm.
felt like this is a better investment even after 10x than it was before,
Mm-hmm.
because the risk is completely gone now. The
Mm-hmm.
capital raise has happened, the company is like profitable, and so like I think you could have started, like I've been averaging into Tesla since 2021 March, and even though I missed the early big 20x, I
Mm-hmm.
still think you could just average in over the next 5 years and do really really well. And I
Mm-hmm.
think that could happen for Lemonade as well, is that we could see a 10x to like maybe $250 a share.
Mm-hmm.
But then you could start buying then after profitability is reached and
Yeah.
still build an amazing position.
Mm-hmm.
I kind of want to be like the Dave Lee of Lemonade in that I bought it for like, he bought it for like crazy, crazy low and
Yeah.
got a big
Yeah.
position.
See,
I just think I just think it'd be
but
cool,
actually, my Tesla story is in 20, well, it was 2013, I think. They had a huge run, like they had like a first quarter where they posted a profit, and the Model
Yeah,
S was coming out, and it got like
yeah,
100 out of
yeah,
100 by Consumer Reports. It all happened in a short window, and I was sort of like kind of following the company, not hardcore like Dave Lee would have been, but sort of following it, and then and thinking about buying some. It never did because there was all this sort of this negative sentiment in the market. Oh, it's too risky.
yeah,
And then I just saw it like take off, and I really felt at the time, I was like, oh, I missed the boat. And then it was like years later, I kind of went, hold on, and it's still following the story. And hold on, there's still
yeah.
like actually ton of opportunity here, and it's still even still, I think, a ton of opportunity. Okay, well, I just want to wrap things up here, and thank you so much, Josh, for coming on, giving your perspective on Lemonade, and giving us your time. And I'd love to have you again in the future. Even I know Investor Day is coming up in November. Maybe after that, we could do another chat and hear your perspective on some of the details Lemonade shares there. And yeah, to find you, if people want to find you on the internet, I think you do have a YouTube channel, right? It's Shady Josh. You might do, I saw one Lemonade video there. You might do the occasional one in the future too.
Yeah,
Is that just,
I might do a couple because actually the video I made was well was I have to say though, I filmed it literally in like 10 minutes with just a ramble. I didn't do any planning, so
yeah,
it wasn't a very good video. But I may do some more well thought out video in the future. And also I refurbish as part of my side business. I buy and sell motorbikes, so
yeah,
that's
yeah.
primarily what my channel's about.
Cool, cool,
Yeah,
awesome,
no, great to be here, and
awesome,
be great to come again. But yeah.
awesome. Okay, thanks so much.